Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, everyone. My name is Hanna Yuliyani from University of Semarang. We will present a summary of my research with the title Increase in Company Value is Determined by Sales Growth, Capital Structure, and Company Size with Profitability as a Mediating Variable. The first is introduction, and this is a background of research. Increasingly, time-based competition requires an increasingly broader scope and role for financial managers. Financial managers must be able to carry out their financial management function so that company goals can be achieved, namely obtaining maximum profits and increasing company value. Instability in company value is an important thing that will influence investor views of the company. Investors are, of course, more selective in choosing companies to invest their capital, so that each company is required to maximize company value. This is a phenomena gap. Based on the table, it can be seen that there is an inconsistent relationship between research variables. First, while the average return on asset increases, the average WQ actually decreases. This shows that there is a discrepancy with scaling theory, which explains that if return on asset increases, it will be followed by an increase in company value. The average debt-to-equity ratio will decreases, meanwhile the average WQ has increased. So this shows that there is a discrepancy with the trade-off theory, which states that capital structure has a positive effect on company value. Average total assets have increased, meanwhile the average WQ has recently decreased. This shows that there is a discrepancy with signaling theory, which explains that if the size of the company will increase as the value of the company increases. Next, this is a theoretical review. Uh, the theory used in this research is signaling theory and trade-off theory. Signaling theory means a signal given by company management to investor as a clue about the company prospect. A trade-off theory is a capital structure theory that states the company exchange tax benefits with debt financing for problems caused by potential bankruptcy. A company value is the investor's perception of the company's success rate, which is generally often related to the stock price. Profitability is a ratio that assesses the ability of a company to earn profits through the company's overall asset. Sales growth is an increase in the number of sales from year to year or over time. Capital structure is the composition of the company long-term funding with debt and equity. And the last, company size is a scale of determination in measuring the size of a company using total assets, total sales, stock price, and other as a measuring tool. This is a research framework and hypothesis. All hypotheses in this research suspected that sales growth, capital structure, company size, and profitability have a significant positive effect on company value. Next, this is a research method. The population is the study where food and beverage companies list on the Indonesia Stock Exchange as many as 98 companies. From this population, purposive sampling was carried out with a total sample of 55 companies. The type of data in this study is secondary data. The data sources in this study were obtained from annual financial report published on the Indonesia Stock Exchange website. Data analysis in this study used PLS, which includes conversion validity, discriminant validity, composite reliability, R-score, F-score, and hypothesis testing. Next, this is a result and discussion. The first conversion validity test. Based on the result, the loading factor value is greater than 0.7, meaning that all indicator can be used to measure the construct because they meet the validity criteria in accordance with regulation and guidelines for use as research tools. Next, discriminant validity. The outer loading value of all variable indicators has a value of more than 0.7 and the HTMT value is less than 1. This means that all of indicators in this research variable are valid and no indicators need to be eliminated. And next, composite reliability. The composite reliability test results show a value of greater than 0.7, which means that all variables are declared reliable because they meet the requirements. Alex and score based on the table above, it can be concluded that the inner model in this study is said to be good. Variable rate asset is able to explain variable total skew by 76.4%, and the remaining 24.6% is explained by other variables outside the research. Next, this is a direct effect and indirect effect. There are several criteria for measuring the direct effect and indirect effect. If the original sample value is positive, then the relationship between the variables is unidirectional, and vice versa. If the relationship between variable has a p-value smaller than 0.005, or the statistic greater than 2.001, then the relationship between variables is significant, and vice versa. Next, this conclusion. Number one is sales growth has a positive and significant effect on profitability. The original sample value of 0.512 is positive, with the statistic result of 4.908, or p-values of 0.000. So these results are significant. Number two is capital structure has no effect on profitability. The original sample value of 0.133 is positive, with the statistic result of 1.664, and our p-values of 0.048. So these results are not significant. Number three, company size has a positive and significant effect on profitability. The original sample value of 0.316 is positive, with the statistic result of 4.55, or p-values of 0.000. So these results are significant. Number four, sales growth has no effect on company value. The original sample value of 0.008 is positive, with the statistic result of 0.0878, or p-values of 0.469. So these results are not significant. Number five, capital structure have a positive and significant effect on company value. The original sample value of 0.512 is positive, with the statistic result of 5.885, or p-values of 0.00. So these results are significant. Number six, company size has a positive and significant effect on company value. The original sample value of 0.160 is positive, with the statistic result of 2.644, or p-values 0.004. So these results are significant. Number seven, profitability has a positive and significant effect on company value. The original sample value of 0.575 is positive, with the statistic result of 4.790, or p-values 0.000. So these results are significant. Number eight, profitability is able to become a mediating variable between sales growth and company value. The original value of 0.294 is positive, with the statistical test result of 4.243, or p-values 0.000. So these results are significant. Number nine, profitability is not able to be a mediating variable between capital structure and company value. The original value of 0.077 is positive, with the statistical test result of 1.471, or p-value 0.071. So these results are not significant. And the last, number 10, profitability is able to be a mediating variable between the company size and company value. The original value of 0.182 is positive, with the statistic test result of 2.972, or p-values 0.002. So these results are significant. Thank you and good afternoon.